the Fed saying, not likely to go negative, but you know what? It's hard to be a bear in a market where central banks, including the Fed, say, you know what? We have what it takes. We'll do whatever is needed.
To be a bear, perhaps, but also hard to be a bull as we look at the global unemployment numbers and the necessary monetary policy going on around the world, as we just heard leading into our segment here. I would say that the weather forecast for the markets globally remains that uncertainty certainly remains in the forecast. It's an unprecedented polarization between both the pessimists, the bears, and the optimists, the bulls.
You talk about uncertainty, especially for demand. I mean, you can supercharge it with low rates, with stimulus. What assumptions are you making about when demand will recover?
It's almost, going off of what Powell said today, we are experiencing something never seen before. Therefore, we simply cannot know exactly when or how we will come out of this. I do believe that there has been an unprecedented coordinated working between the administration here in the U.S. along with the Fed and the Treasury. But we have to look backwards and remind ourselves that what started out as a predicted multi-month phenomena is now headed into a multi-quarter, perhaps even longer term territory. And let's not forget that this really was supposed to be a short-term hit to supply, a short-term hit to demand, and that was going to require a short-term change to growth expectations, and the ripple effect has been far greater than I think anyone had ever expected, and almost unprecedented in its impact to the global markets, and then also having this systemic impact to trade. The tensions between the U.S. and China, the tensions between China and Australia, we can go on and on, but this is going to take quite some time to recover. And then when you add oil into the equation, I think we're all looking at something that is multifaceted and needs much consideration.
So, Nicole, if you take a longer-term perspective, are there any dislocations in the market right now that you can capitalize on?
Yeah, I think there's a couple of things. One, I think all too often when we talk at this overarching thematic level, we really have to remind ourselves, are we talking about an investment that is currently today in cash or a cash proxy and looking for investment into the market? And to remind ourselves not to anticipate or attempt to time the amount or the vast volatility out there. And volatility generally, when high, stays high for quite some time. So these dislocations, though, there are quite a few. In the U.S. market here, if you strip out just a few of the big names in technology, Apple, Microsoft, and you take them, remove their capitalization weighting out of the S&P, you'll see very different numbers, or a very different return to the valuations we've seen previously. You can actually add together the energy infrastructure, manufacturing, and real estate sectors of the S&P, and you'll have a smaller capitalization weighting than those two previously mentioned companies combined. So there is dislocations, and certainly those stronghold names will continue to be a value for investors. We need to invest in companies today that we know have the access to liquidity, have the consumer base, and have weathered storms before and know how to navigate them.
Nicole, it's Rich in Hong Kong. So what is actually being priced in then? Market participants obviously looking at 3 to 6 months ahead, and I think largely getting ahead of themselves. We've got two big investors, of course, out there as well. David Tepper saying that a quick snapback is fantasy. Stan Druckenmiller saying that the risk-reward ratio is the worst he's ever seen.
New numbers that we were looking at just over the last couple of days, here in the U.S., 30 million people have lost their jobs. 77% of those people expect to be hired back. But what we are really looking at is it's likely that about half of those jobs are permanently lost. It is to some degree fantasy to think that there is a V-shaped recovery or even that Nike swoosh-shaped recovery When you think about just how hard it is to onboard or rehire, in the lag on that of 30 million unemployed people, we're talking about unemployment numbers in the U.S. approaching 10%. You can couple that with every bailout package out there and the trillions of dollars of stimulus. And while I do believe that there are enough tools in the tool belt to weather this storm, that long-term growth expectations don't need to necessarily change. In the short term, there's a big impact and something that I don't think has been effectively priced into the market. It's going to be very hard for the consumer to go back to normal behavior until there's either transparency in testing and antibody or there's herd immunity. And as of right now, we don't have clarity on any. You actually see Cuomo, the governor of New York, tackling with de Blasio for Manhattan, saying, he came out with a tweet over the weekend suggesting anyone who tells you that they have any clarity is lying because there isn't any. And the markets haven't really effectively priced that back in yet.
Nicole, just briefly here, I think you're getting right to the heart of it when you talk about the consumer, and the biggest fear is losing your job. And if you continue to see the jobless rate go up as it did in the last non-farm payroll report, it does create a situation of uncertainty. People who do even have jobs then don't spend, and it turns the whole money multiplier from a virtuous circle into a vicious one, does it not?
Absolutely. The consumer behavior, and this isn't as isolated, as perhaps it felt during the financial crisis. I think early on, and one of the reasons why the market bounced back so quickly was there was this human component to it where people said, I am choosing to change my behaviors. I am choosing to shelter in place because it's for the best for humanity. Now, as we continue to watch this, what we're seeing is the consumer is actually quite hesitant now to understand or totally grasp when it is that they go back to normal. In numbers that we saw come out over the weekend in the U.S., a large study suggested that if people were told they could go back to living their life, would they? Would they travel? Would they go to restaurants? And what we saw was about 75% of people were saying no, they would not return to normal behaviors yet because there isn't a vaccine, there isn't an antiviral, there isn't clarity around antibody testing, and they're not feeling well prepared. They don't understand that impact yet. So I think we can talk all day long about reopening economies, but we still have major issues to overcome first. And also, we also saw Twitter announce today that they're not going to make anyone go back to the office indefinitely. So what is that lasting impact on real estate? And I think that's another game changer that has to be priced into the market.